Jamie Dimon. I've got a couple things to react to in regards to Jamie Dimon here today, folks. Big comments that I want to give a perspective on, okay? Jamie Dimon says S&P could fall another 20% easy, he says, okay? That's a massive comment. So I want to react to that, what he's saying there, okay? Then we're going to react to this in a video where investors should raise cash ahead of a down year, says Jim Cramer. So he's basically telling investors you need to, kind of sell cash up essentially, okay? I want to react to that, give my perspective on that, and hear what his points are there, okay? And then we're going to react to another Jamie Dimon video from here today that I thought was a big one. Jamie Dimon warns U.S. likely to tip into recession in 6 to 9 months, okay? So we're going to react to all three of those. Two of them are really short clips, but, and by the way, if you ever want to say hi to me, and you enjoy the videos and whatnot, send me a DM on IG, okay? Before I get into this, I want to give say something, okay? What is the first thing you were ever taught as an investor in the market? The first thing you're generally taught is don't try to time the market, right? And everybody says this all the time. But as soon as times get tough, what does everybody start doing and telling everybody else to do? Time the market. It's what they all go to, okay? And so when Buffett says the old saying of when the tide goes out, you find out who's swimming naked. It's not just about who's going up or down on stocks because, if you're in a major down market, everything's kind of getting swept out to sea, right? It's about who's got a strategy that sticks and sticks by that strategy and who you find out really doesn't have a strategy and they're like all over the place and it's like, oh, sell, buy, I don't even know what to do, okay? And it's about that consistency as an investor and having a plan that, regardless of a bear market, bull market, here's how I'm approaching the market and here's how I'm making these moves out there. Because what these other folks are basically, in my opinion, kind of telling people to do is getting them into really bad habits. And as the great Warren Buffett says, when you get into really bad habits, they're really hard to break. And that's what I see a lot of people getting into now because the Nasdaq's down 33% or something like that year to date. When you're in that sort of year, a disastrous year, everybody wants to start timing the market, okay? And, as they say, when it comes to timing the market, you got the people that think they're smart enough to do it and really aren't, and you got the people that are smart enough to realize they're not talented enough to try to play that whole game. It's a very tough game to play, but it sounds good in theory, okay? Alrighty, guys, let's get into this first one. Huge comments here out of Jamie Dimon. S&P could fall yet another easy 20% from current levels. That's big.
Of distress. So you saw it. I mean, this again is fairly typical. Markets go down for, people forecast the economy, et cetera. The IPO market closes first. That's kind of happened. High yield closes second, and structured credit, that's kind of happened for the most part. Things can get done, and then it starts to affect other credit. You saw with the gilt markets here, you see a lack of liquidity in a lot of markets. A lot of intermediaries can't intermediate like we used to because of regulations. It is going to happen. And I think the likely place you're going to see more of a crack and maybe a little bit more of a panic is in credit markets. And it might be ETFs, it might be a country, it might be something you don't suspect. If you make a list of all the prior crises, sitting here, we would not have predicted where they came from, though I think you can predict this time that it probably will happen. And so if I was out there, I'd be very cautious. If you need money, go raise it.
What about stock markets? Where do you see the trough for the S&P 500?
Oh, I don't know. Look, it may have a ways to go. I mean, it really depends on that soft landing, hard landing thing. And since I don't know the answer to that, it's hard for me to answer that. But it could be another easy 20%. And I think like the next 20% will be much more painful than the first. Rates going up another 100 basis points are a lot more painful than the first 100 because people aren't used to it. And and I think negative rates, when all is said and done, will have been a complete failure.
All right, so I have a problem with what he just said there. Okay. I don't even have a problem with if he really feels like the market could go down another 20%. That's fine, okay? What I have an issue with is the whole way he addressed that situation, right? Oh, I don't know. Market could fall an easy number, another 20%. Mr. Jamie Dimon, you are the most important person in all of finance in the private sector, okay? You can't just throw stuff like that out there. Be like, I don't know, S&P 500, it could fall another 20% easy. Like, do you know who you are? You can't just throw stuff like that out there, right? And be like, I don't know, 20%, yeah, easy. It's like, dude, do you realize how insane that is? then you're talking about a S&P that's on par with the great financial crisis then at that point, which is a dramatic situation you're talking about there. And that was a situation where the banking system almost collapsed. So Jamie Dimon, you're saying your bank is going to potentially collapse? Because that's what we saw in the last time. We saw the S&P 500 go down around 50%, which if you tack on another easy 20% to the S&P 500, you're getting right around that 50% mark then at that point in time, right? So, which is an extraordinary number. So that just bothers me how he approached that whole situation. You can't, in his position, you can't just throw numbers out like that, man. You got to think about these things, and it just bothers me about that whole endeavor there. Okay, so next video up here: investors should raise cash ahead of a down year, says Jim Cramer. These folks really want to put me in a bad mood tonight. Oh boy, okay.
But this change, I mean, even when you look at the Journal headline from this morning. At 7 a.m., futures not looking so good. Right. We're heading into another bad morning potentially as a result of the increase in hostilities in Ukraine, unfortunately. Continued goings on in the bond market in the UK. Pick your poison. What happened?
Well, first of all, it's a holiday, so bonds can't hurt us. Bonds have been hurting us. Second, Friday's reaction to both AMD's pre-announcement, I don't know, was really linger on Friday, and to the jobs number was so negative as to almost build in, say, another 50 basis points. So people are now talking about 4.25, 4.5, maybe 5. The 2-year tells you that it's going to be 5. I mean, because 2 years is going to continue to go down and pricing up yield. So then you start thinking, well, if it's only going to be, say, 5, then maybe it's not the end of the world if it's done slowly. And what a lot of the commentators were saying today, we're done slowly but getting there, and that's a lot better because that's less catastrophic.
Right.
So look, I mean, what I'm basically saying is it's real bad, but it's not so bad as to be too. I know.
We don't really know why the futures turned around, and who knows what the rest of the day will bring anyway when we start trading 27 minutes from now.
Think about it. This morning at 4, what was the theme? Well, okay, so Britain's panicking, all right? So Russia's really stepped it up. We're really stepped it up against China.
Causing even more carnage, yes.
Ford's going to miss the quarter. It got that one very early because it's a European call.
UBS, you mean the downgrade?
Yeah,
we'll get to that.
We got the Procter downgrade, which was vicious and horrible and mean. That's because my child just owns it. And you come back, even Bristol Myers was downgraded, Dave. That's not supposed to happen. Guggenheim. So what you come back to is perhaps it's another one of those sentiment moments where you had a trilogy here. You got the CPI, the PPI, and then you have the jobs, but the jobs is far away. Is it really possible that one of those, that all three are going to be bad? Were last time. What happened to PPI? It's not so bad. So I think people are betting that the first of the three might be okay, based on the fact that we don't have to worry about the bonds today.
But we are going to start to get earnings. We just looked at it.
Yeah. The market went down, by the way, just so everybody's aware.
Looked at a wall graphic, Pepsi, and then obviously a number of others, and then the banks later in the week. Jim, there are still those who believe that S&P earnings are going to come in next year below 200, that we're going to start to get the guidance that apprises the market of that fact,
right.
That we've had demand destruction from rates that we haven't seen the end of yet. The wage increases that we've talked about are still coming through, not to mention expenses are higher in general. People are traveling again at companies, for example.
The balance sheet of America, as I was reading a Quartz article today, using St. Louis Fed, the balance sheet for individuals is now lower than 2008. You signaled that to me last week when you said that the consumer's more strapped than you realize going into a possible recession.
Right.
Just extraordinary.
It is. And so you can, there are those who still want to make a case for the fact that if you apply a 15 multiple in the S&P and you really think we're going to get a number for earnings next year that's around 200, we've got a lot more downside.
We know. If only everybody would have admitted we're in a recession, that would have been a whole different perspective on this game. But because everybody doesn't want to admit the truth in this whole scenario, right? It's like pushing the can down the road, and it just makes for an uglier sentiment kind of situation that elongates out.
Going into a down year is a clarion call to raise cash. We know that cash is giving you a great return. So all you can really hope for as your bull is that the price target cutting stops and that the industrials have stimulus money from actual building of things. But David, you don't have anything related to PCs or cell phones, and you have nothing related to China. That's a big chunk of the market that is a hole in 2023 earnings.
Yeah.
Okay, so fair and not fair. Okay, so first off, once again, the core issue I have with this is this whole timing of the market thing, right? And the second issue I have with this, there's probably a lot of issues. The second issue I have with this, look at the way these stocks are priced. AMD's trading at $50-something today. Was it $56, $57, right? And who knows where the bottom is. Maybe today was the bottom, maybe tomorrow's the bottom, maybe, 47's the bottom, like who knows, okay? NVIDIA is trading at $115 today or whatever, right? And those stocks have been absolutely smashed. Now, I don't want to say everything is priced into those stocks, but a massive chunk has been priced into those stocks. That's how you got those stocks down 60+% year to date, right? And so I think that's a factor that shouldn't be lost on folks that how hard these stocks have been devastated, right? Now, if you want to make the case for Apple to go down more, fair play there, but also remember Apple's a different behemoth there, that if somebody's iPhone breaks, they go buy another iPhone, bottom line, right? And also it's they make a lot of wants products as well, plus needs-based products, plus they have the services revenue, and they're kind of considered the creme de la creme in the market. And so when you have that, you kind of people like to hide cash there, right? Which I don't want to say gives a total base under the stock, but it definitely gives a good base. That's why the stock's performed so darn well this year, to be quite frank, outside of obviously some very impressive earnings reports, right? Next issue I have is Jim Cramer basically saying there that, hey, you know what? Earnings could be down in 2023 and down quite a bit, right? And so, you want to raise cash going into a year like that. Well, Mr. Cramer, in all due respect, why do you think the market's down so much this year? The market's always forward-looking, right? And so if we're in a situation here, think about this. This is important, okay? Earnings have been pretty decent this year, actually, right? So why is the NASDAQ down 33+%? Well, the reason the NASDAQ's down 33+% is a multitude of reasons, but one of those core reasons is the expectation that there's a possibility of earnings being down in 2023. And so that's why the market's down so heavily. It's pricing in that realistic possibility of earnings being down in 2023, right? And so the market's always forward-looking in these situations. Why was the market starting to rally in March of 2009? And as we went throughout 2009, even when the economy was in a horrible place, and a lot of things were in a horrible place, right? And real estate was still bad for 2+ years after that. Why was the market rallying? The market was rallying because it was looking to the future. It was understanding earnings have likely troughed, and they're likely going to get better from here, right? So if the market starts to come up with the assumption, and we'll see if this plays out, the assumption that Q4, Q1, Q2 earnings are kind of the trough and things are going to get better from there, it starts pricing that in 6 months ahead of time. And the market starts moving. Even while things are still quote-unquote bad and people don't understand it, they get very frustrated, right? The same thing happened in March of 2020 and in many various situations in the past where the market moves way ahead of situations, and people, sometimes it's hard to understand, especially at first when it's happening. Like, well, why is the market moving down so much and we have all this good news? Or why is the market moving up so much and we have so much bad news? I've seen it play out a million times just in my 14 years of being in the market. Never mind the whole time before I came in this market, which this game's been going on for a long time, right? And so those are some factors to keep in mind there. If we have some massive rally in November, December, and that's a situation where say you're really tight on cash and you need to raise some cash, okay? But to raise cash and when what are you going to do? Let's say your stocks are down massive. Let's say you own AMD and Nvidia and Apple and Tesla and some of these stocks. You're going to sell those now? When the NASDAQ's already been hit 33% this year, when a lot of those stocks have been hit, especially in Nvidia and AMD's situation, 60% plus, are you selling those now to raise cash now? And then if you are, when do you deploy that cash again? In 3 months, 6 months, 1 month, 1 year? That's a whole other problem, right? It's like you have to get it right both times. And you didn't get it right the first time or anywhere even close to it, right? So, you got to think in terms of, some of these stocks over the next few years. Do they have much more likely upside or downside over the next few years? I think that's just a good way. if your life was on the line in the next 3 years, right, would you say there's a higher probability AMD stock is higher in 3 years? I'm just using that as an example, right? Because that's obviously the one that's been in the news so much lately. Is there a higher probability that AMD is higher or lower in 3 years from now, right? And if you had to put your life on the line, what are you going with in that situation? And I think when you think like that, the context begins to change a little bit, and you begin to understand, okay, this is a little bit of a different game we're playing here. J.P. Morgan's Jamie Dimon warns U.S. is likely to tip into recession 6 to 9 months. Okay, let's watch this one now.
Things in mind here. Currently, right now, the U.S. economy is actually still doing well. Consumers have money. Fiscal stimulus, they still have more than they had before. They're spending 10% more than last year, 35% more than pre-COVID. Their balance sheets are in great shape. Yes, debt's gone up a little bit, but not nearly to pre-COVID levels. And therefore, even if we go into recession, they're going to be in much better shape than 08 and 09. Companies are in good shape. Credit's very good. Markets are still open, though rocky and stuff like that. But you can't talk about the economy without talking about the stuff in the future. And this is serious stuff, okay? This is inflation, which obviously is, changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And
the W is the biggest risk factor that I see out there personally, right? That's that thing that just you can't control. Well, you kind of can control it, but you can't really control it, right? That's the biggest thing I personally worry about if things went even worse there, right? Because if that never happened, I think the market would be in a very different place. I don't think it's out of the realm of possibility to imagine this year would have been a down year for the market potentially. But this dramatic, it wouldn't even have been close. What that situation did to the oil markets, to natural gas markets, to Europe in general, right? To the devastation there, to the bond market, to investor psyche, to overall confidence, to inflation, to the Fed's decisions, dramatic. Okay, I would call what happened there is almost equivalent to economic war. Okay. That's what I would call that, because it has caused trillions of dollars of wealth to be lost in this situation because of that decision to go in there. That never happens. The markets aren't damaged like they're damaged. These stock prices aren't damaged like they're damaged. So because that decision was made to go in there, we are paying the price for that in terms of obviously the market, right? Now, if you're a long-term investor, you might be applauding that and saying, thank you for the deals, right? But just the honest truth is, the market, I'm telling you, would be in a much better place because the Fed would have never had a raise as aggressively as they did. Commodities would have never went through that super cycle like they did. Europe wouldn't have been devastated like the way they did, and just all these various factors, okay? So just something to keep in mind, and I definitely worry about escalation there in terms of that.
The world, Europe is already in recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now.
If we do see the U.S. go into recession, how severe do you expect it to be, and how long do you expect it could last?
Yeah, well, this is the thing no one ever really knows, right? You have a strong consumer going into it. Businesses are in pretty good shape, but they were amazingly resilient during COVID. Even the ones that had no government support and stuff like that. And I think governments did do a hell of a job getting the thing to recover. So we don't know. Now you have to look at the range of outcomes. It can go from very mild to quite hard, and a lot will rely on what happens to this war. Mm-hmm. So I think to guess is hard. Be prepared. Yeah. But the one guarantee, which we've been consistent about, is volatile markets. You're going to have volatile markets. You've already seen markets down quite a bit. No IPOs, very little high yield, bridge loans being hung and stuff like that, which is pretty typical. But it's still been orderly. I think it's possible you're going to see it be disorderly sometime in the not too near future.
How do you think the Fed is doing in managing this whole situation?
Well, let me give them credit for what they did in COVID. And I hate to second guess people because I think it's easy for everyone to do. In hindsight, they waited too long and did too little, and QT should have started sooner and all that. But they're clearly catching up. They're clearly motivated to catch up. And, from here, let's all wish them success and keep our fingers crossed that they manage to slow down the economy enough that it doesn't to cause it, whatever it is mild. And it's possible. I wouldn't take that off. I think, like I said, the far more serious thing is this war. far more serious than the short-term effect of the economy and things like that.
First off, Jamie Dimon, how dare you second-guess your boss, Mr. J. Powell there, okay? In all seriousness, yeah, I agree with Dimon there, Jamie Dimon, in regards to the W's are the biggest risk for this market, 100%. It is by far and away the biggest risk I see out there for the market, right? Inflation, eventually things are going to work out there. If there's any sort of major escalation in the W situation, that can make the commodities market go crazy again. That could cause even more devastation to Europe in general, right? Plus, there's a lot of worries about much more serious things. Let's just call it that, right? Plus, if the government has to focus more on that, then the focus becomes less and less on the economy, which causes problems, okay? So there's no doubt, if there's one thing that I personally worry about, it's that situation that I'm like, let's hope things work out there. But outside of that, the market's going to be the market. As a long-term investor, you can't get caught up in all this stuff and hysteria and it's very hard, and especially if you're a newer investor, it's very, very difficult. And if you're in your first few years of investing and you're investing in this sort of market, it takes a lot of belief and it takes a lot of confidence, to be quite frank, because this is definitely one of those markets that very rarely comes across, and it tests you as an investor. And you don't have these markets come very often, right? 08, 09 was that sort of market. Obviously, the tech bubble crash was that sort of market. This is that sort of market. They very rarely come, but when they do, it's especially as a new investor, it's very difficult to deal with. And so I applaud all investors who are staying focused on the long term and are adding assets that they really believe in for the coming years, and trying to look past kind of the short term stuff. And as an investor in the market, you have to always have a belief that tomorrow will be better than today, right? And things will work out and the world will figure stuff out. And because there's always these risks, they're never going to go away, just so everybody's clear about that. Russia's not going away, just so everybody knows that. Any geopolitical concerns, they're not going away. China, Taiwan's not going away. All those things are going to be there and be there forever. And so, I just think that's kind of the way to understand it, is understand that that's part of the game and it's not going away. And so therefore you just have to deal with it and accept that that's a risk factor of investing in the market, right? No different than we accept all the different risk factors of investing in a stock. So that's my frame of thought around that. I appreciate all you guys joining me. As always, 15,000 plus strong on this channel now. Thank you for everybody that subscribed to the channel. I appreciate all of you. And also, if you ever want to say hello to me and you enjoy the channel, Financial Education Jeremy on IG, and send me a DM. Much love as always, and have a great day.